Hi everyone, today we are going to talk about the power of using 20 moving average in trading any financial instrument. The 20 moving average is a very simple but a very effective tool to analyze price action. Depending on your style of trading, you can choose a suitable time frame to trade using the 20 moving average. The recommended time frames are 60 minutes if you're a day trader, daily time frame if you're a swing trader, and a weekly time frame if you're a positional trader. So how does the 20 moving average help you as a trader? Let us understand that in a little more detail. 20 moving average essentially helps us in three ways. Number one, it helps to understand the current trend of the financial instrument. Secondly, it helps to understand when the current trend is changing. And finally, because of all this, it helps us to know when to be a buyer and when to be a seller, and also when to stand aside. A very simple rule that we follow while using the 20 exponential moving average is, if the current price is closing above the 20 moving average, our underlying trend is up. If the current price is closing below the 20 moving average, our underlying trend is down. And lastly, if the current price is trading around the 20 moving average, that is, if the 20 moving average line is flat, we'll assume that our trend is sideways. Let's understand this point with the help of an example. Remember, although we are going to take example of stocks here, the same logic, the same principle can be applied to trading any financial instrument, whether it be gold or silver or crude oil or currency, etc. etc. The logic, the concept remains the same. In this particular video, we are going to take example of stocks. The first stock that we are going to look at is TCS. I am presuming that we are swing traders and we are applying this 20 moving average on the daily time frame chart. On my chart, you can see that I have entered 20 EMA. Now this EMA stands for exponential moving average. Now friends, this will be too short a video to explain the difference between an exponential moving average and a simple moving average. But to keep it simple, let us understand it this way. The exponential moving average gives importance to the recent price data and is more sensitive to price action, whereas a simple moving average gives equal weightage to all the data in the last 20 days. Since EMA is more price sensitive, for our analysis purpose, we are going to use the exponential moving average. Please remember, there won't be a huge difference in the outcome if you either use a 20 simple average or a 20 exponential average. But as a matter of preference, we will always stick to the EMA, which is nothing but the 20 exponential average. Coming back to TCS, you can see that the stock moved above the 20 EMA on 3rd of August 2021 and thereafter continued its rally till 16th September 2021. Now, post the stock closed above the 20 exponential average on 3rd August, we saw almost a 20% rally in the matter of month. In other words, closing above the 20 moving average on 3rd August gave us an indication of an upcoming rally in the stock. Now let's see what happened in TCS somewhere around 28 to 29 September 21. As you can see, the stock closed below the 20 moving average for the very first time in the last 1 month. Resultantly, the strong uptrend in the stock got punctured and the stock kind of went into a sideways trend, as you can see from the price action. Finally, on October 21, the stock closed convincingly below the 20 moving average, and this was the beginning of a short-term downtrend in TCS. You can see that post the stock closing below the 20 average on 11th October, the stock price went down from around 3,700 to 3,400 within a span of 22 to 25 trading sessions. Thus, the stock closing below the 20 average gave an indication of an uptrend changing into a potential downtrend. Once again, you saw very similar price action as the stock went sideways for a certain duration, and finally, recently, it has managed to close above the 20 moving average. As we are talking right now, the stock is making an attempt to make another strong up move with the price closing above the 20 moving average. We can also see bullish candles somewhere forming around the 20 moving average line. We will not be surprised if we see a very strong rally in TCS from the current levels which can again all the way go up to 3900 levels. The chart of TCS is a great example how a simple tool like 20 EMA helps me on being the right side of the price action. Now everyone is talking about Nifty with the kind of movement we had in the recent past. So we'll try and understand and apply the 20 moving average logic on the Nifty index itself. Now earlier we took an example of a swing trader and we applied the 20 moving average on daily time frame. In this case, I will assume to be a positional trader and thus I will apply this 20 moving average on a weekly time frame. Now what's the price action on the Nifty index on 28th of February 2020? This was a time when COVID had started to spread all across India and there was news of lockdown coming across the country. On Nifty chart, we observed that price closed below the 20 moving average with a strong red candle, which gave an indication that the uptrend that we were observing in the past few months has come to an end and Nifty was showing signs of changing the direction. Now just look at what happened to the Nifty price chart once the price closed convincingly below the 20 moving average. Within no time, prices fell from 11,200 all to 7,800 levels. This was a peak of COVID crisis and finally market made a bottom of 7511 somewhere around March 2020. Post that, we had a strong bounce back and for the very first time, we had Nifty closing above the 20 exponential moving average on 5th of June 2020. Just look at the price chart once Nifty closed above the 20 EMA on 5th of June. We had a one-sided rally in the market and every time the market fell down, they nicely took support at the 20 moving average and went back again. This continued till 20th October 2021. As we are talking right now, for the first time in the last so many months, we are seeing Nifty showing signs of closing below the 20 moving average. This is a very, very significant thing because this has never happened in the past almost 1 year. We will not be surprised if market gets into a strong downtrend or a long drawn sideways momentum from these levels, which would be a good thing because that would mean the crazy up move that happened in the last 1.5 years will come to an end and markets would return back to rationality. Now, this was another simple example of how simple tool like 20 moving average helps me in trading the price action accurately and helps me in being on the right side of the price action. It seems to be ridiculously simple for anyone to follow, but we all know, friends, sometimes the most simple things, not only in trading but also in life, the most simple things tend to be most efficient. Unnecessarily, we make things complicated. So do try and use the power of 20 moving average in your own trading and see the difference it makes. It will surely help you to be on the right side of the price action. Thank you very much for the time being. I look forward to seeing you soon. Please don't treat this as a recommendation. Conduct your own analysis and do your own due diligence or consult a financial advisor before taking any investment decisions. Thank you.